Every stock on this channel goes through the same scoring model. One verdict: buy it, watch it, or avoid it. No hype, just data. Two-sentence thesis. GameStop is sitting on one of the most impressive cash hoards relative to its size in retail. Nearly $9 billion in cash and investments against a market cap in that same neighborhood. But the underlying business is shrinking. The DCF says fair value is around $4, and the stock at $24 is almost entirely a bet on sentiment, short squeezes, and what management decides to do with that cash pile. Until revenue stabilizes and returns on capital improve, this stays on the watch list. Here's the market structure picture. Price structure score comes in at neutral, signals split. Price is sitting almost exactly on the short-term support at $24.10. Both short and long-term price action are in a holding pattern, meaning the market isn't aggressively buying or selling right here. The 60-day forecast is essentially flat, -1% drift with 90% confidence. The model is saying hold, not buy or sell. Smart money is slightly negative with negative velocity. No institutional conviction building right now. The key level to watch for any directional move is $25.40. That's the short-term upper resistance. A clean move and hold above that opens the door toward $37 and beyond. Below $24.10 and the stock drifts back toward $23. Short interest at 15.17% with 4.2 days to cover is the wild card. Any positive catalyst, earnings beat, Bitcoin announcement, activist news, and this thing can move fast and hard in either direction. Two very different stories living inside this one stock. The balance sheet is elite, $9 billion in cash and investments. Net debt is -$1.9 billion. Free cash flow at $187 million last quarter, with cash conversion at 151%. Earnings quality flagged as elite. Real cash behind the reported profits. Financially, this company is fortress level. The business is shrinking. Revenue down 13.9% year over year. The core retail model is losing ground as gaming goes digital. Gross margin held at 35% and they're still profitable, but ROIC is only 1.17%, below the cost of capital. Growth isn't creating value yet. The punchline: cash per share is roughly $20. The stock trades at $24. You're paying $4 for the actual business, and the DCF says that business is worth about $4. The DCF says $4.31. The stock trades at $24. That's a 460% premium to fundamental value. Back out the $20 in cash per share and you're paying $4 for a business worth $4. Zero margin of safety. Bottom line, GME is one of the most interesting and most dangerous watch list names we cover. The cash is real. The Q4 profits are real. The squeeze potential is real. But the business is shrinking. The DCF says $4 and you're paying $24. That gap only closes if management deploys the cash brilliantly or the business fundamentally turns around. Watch $25.40 for the breakout signal. Hold $23 as the floor. And watch what management says about deploying that $9 billion. That announcement, whenever it comes, will be the biggest single catalyst this stock has. Like and subscribe. Same system, every stock, no hype. See you in the next one.